Good morning, this is Richard Pears from FinextraTV, and this morning I have with me Tim Coates from Synechron. He's the head of ecosystems. Good morning.
Morning. Thanks for having me, Richard.
So, thanks for having some time with us today. We're talking about sustainable finance, and I know that you've been working in your ecosystem role in some exciting projects. Sustainable finance, obviously, we're trying to get the capital, $90 trillion of assets under management, flowing towards all the sort of projects in the world. But people need to understand, what's the data quality, what are the ways that they can distribute those products, etc. And this is where you focus. Am I right? Can you tell us more about that?
Sure. Yeah, I think the sustainable finance movement maybe has existed since the Kyoto Protocol in the late 90s and has really struggled to ever move itself to impacting the bottom line of the corporates who we need to impact. And I think we're slowly getting there, but the major barrier that everyone sees is that the quality of data just doesn't exist for me to make a wise investment decision. I can't compare companies particularly well, and then the quality of data is spurious at best, that we're relying on audits and company disclosures without much frequency or reliability. So a lot of effort still to come there.
And so when you go into the projects that you've been involved in, I know you were telling me about one, can you sort of give us a sense of what the ambition of that is, and then unpack that a little bit?
So I think our thesis is that going forward, a security factor, an investable factor, is going to be personal preferences. So in our day-to-day lives, we'll choose free range versus caged eggs, or we might, in our investment life, choose not to invest in cigarette stocks or oil stocks. I think that's more and more going to be a case, and the solutions need to be able to accommodate for personal preferences and the fact that I might have a different belief system to you. Whereas a lot of the sustainable finance, ESG-related solutions are very much one-size-fits-all. You'll get a score for a company's stranded asset risk, for example. And we think stranded asset risk is the most interesting factor going forward in this space. It's the risk of unanticipated devaluations in the value of assets due to external events, and a carbon price is a good example of an external event. And the interesting thing about a carbon price is it will impact every company and industry very differently. And so if we had a carbon price tomorrow versus in 50 years, if your belief is somewhere along that spectrum that that's going to happen, that should disrupt some industries significantly. A good example, today about 15% of the world's carbon is covered by a pricing scheme, and the average price is around $8. And then if you talk to scientists and the guys around the UN Sustainability Development Goals, you need to really get up to about $150 carbon price per metric ton to really make it an impact. So $8 isn't going to cut it, and if you think this factor is not going to go away in the future, then you have to assume that carbon price is only going to go up.
Yeah.
If the carbon price were $40, an airline, about 40% of their revenue would go towards paying a carbon fee. So clearly not sustainable for that industry and any other supply chain industry.
So when you look at all of these factors, and I agree, there's all of this diversity of opinion and standards, etc. And then you come into it as Synechron, who are obviously a business modeling, design, technology firm, and you're given a project to this, and you sort of look at it. How do you start to try and crack the data solutions, or how do you actually try and present answers to these conundrums?
Yeah, so we probably take a lot of inspiration from the traditional investing world and then try to apply it to sustainable finance. And more and more our clients in the traditional finance world, for regular equities and bonds, etc., are looking for those recommender type solutions that recommend the next best action that a customer should take, or that a salesperson should take to a customer. And so with that theme in mind, that's traditionally, you look at the data science practice, which is a booming sector of the consulting world and the technology world, to create solutions based on matching a customer's profile and what we understand of their preferences with the types of companies that fit with their profile, like help guide them to investments that fit with their belief system.
Which I guess has always been the way. The thing I want to press on is this data, this quality of this data. So, if you're saying, I know what you want, and I know that you want to have, you want to invest in, low carbon based companies. How do you source the data that gives you a sort of a sense that, that is really the truth of it, and it's not just a self-reported, position?
Yeah, so that is the challenge, and so we've gone through that challenge. The data aggregating companies, those big firms out there, the S&Ps, the Refinitives of the world, do have an amazing data set, and it goes back sort of, now we're getting to about at least a decade old information, which is good. You can start doing with something with data that's more than 10 years old, if it's consistently reported. So we're getting closer and closer to be able to build real correlations and real advice out of that. But yeah, remains a iterative process to say, well, what is the most reliable data, and I think customer trust in that is going to take time to build.
So is the answer that you just need many data sets, and you need to use the capacity that the cloud and big data and machine learning and artificial intelligence brings you to be able to crunch that volume? Because you just don't know really what's the good stuff. So
exactly. So you've got those big providers will provide about 450 data points around ESG for a corporate, right? So yeah, you might have limited trust in that segment of 10 there and that segment of 20 there, but as a whole, you can start to weed out the false positives and false negatives when you have something of that scale. But it could, well be that it's still 5 years away of data collection till we can really pick out the correlations between those factors and prices, stock prices, and really try to draw that bottom line impact of financial reporting, good disclosure.
Final question, just in terms of, I think you do a little bit of work around DLT Blockchain. Do you think that data that will be coming up from supply chains, where you've been able to sort of control the veracity of that through the blockchain and feeding that into these pools, will that help?
There's definitely a class of people that'll believe that they'll take that view, that it helps give you greater view of the underlying, greater transparency into the source of data. I guess my concern is that it's still going to be garbage in, garbage out. It's a technology. It's not a magic silver bullet, and you got to keep reminding that it's someone still has to put the right data in. And that's no different to any other technology. And I think, frankly, it's that input that's the problem in this world. It's not a technology.
But with a consensus mechanism that would not help to actually verify some of that data?
It depends what the source of that data is in the first place. It remains that, and I think people have, we're getting there on that understanding. But yeah, green bonds and etc. People are always, just like with mortgage-backed securities as well. The theory was that a blockchain could help you have a view of the underlying assets that you're acquiring, and when you securitize something, it remains the same challenge in sustainable finance. I personally don't believe that that's going to be a solution there.
Yeah. So as much data as possible, crunch as much as possible.
Yeah, it's going to be the boring old solutions that are iteratively get there. There is no step change, put it that way.
Fantastic. Tim, thanks so much for coming in and sharing your thoughts with us today.
Thanks, Richard. Cheers.